I'm so happy that you joined us today, Cameron, and welcome to Dividend Talk, and to a European audience, let's say.
I'm happy to be here. Thank you so much for having me. I really appreciate it. I'm excited to kind of hear your perspective and chat a little bit.
Cool. Just before we start, do you just want to give our audience maybe a brief introduction of who you are, what you do? Don't have to be too long, just something brief.
Sure. I'm a professional CFO. I've been investing for probably 30 years. Started as a boy, and during the pandemic, I started a vlog on YouTube, just as my journey evolved, and I've been blown away by the response. And I continue to lean into it, and it's focused simply around what is the true cash flow of a business and how much should you pay for it.
Cool. And you mentioned CFO. Is it possible to put an F still in front of it, or?
Yeah, free cash flow. I love free cash flow, and I've kind of carved a niche out for myself professionally as a career, turning around struggling companies. I'm now in my third round with this private equity group, and I take what I've learned at the board meetings and M&A acquisitions at the corporate level, and just lay it out as simply as I can to educate the people who are interested in learning. It's not rocket science. It just takes a little bit of practice.
Nice. So I think that's a good intro anyway to maybe start getting in a little bit into the interview. So we'll start you off maybe with a nice, easy question. You said that you're investing from quite a young age. So do you remember when you started, and what inspired you to start at such a young age?
We got the paper delivered at the house when I was a boy all the time, and I would open up. I grew up in Los Angeles, as we get the LA Times, and it has a big business section. And I remember looking through all these numbers in the business section, just page after page after page of fine print, and just wondering, what is this? It's just visually very interesting. And then as I learned that these were actually prices that I can buy companies that I liked, I was curious. So I asked for a share of Nike and a share of McDonald's for my birthday one time. That's all I wanted, and
Wow.
And I got it, and I didn't know what to do with it after I had it. I was like, I had a stock portfolio. It had one share of McDonald's and one share of Nike in it, and I was, I don't know, 11 or 12, and
Wow.
it just there it sat. I didn't do too much with it, but it was interesting to have it and start thinking about what that meant.
So that would have
Do you
been
still own?
sorry, but that would have been before online brokers. So
Yeah.
you would have had to physically go into a bank and get that piece of paper.
Yeah, I think I paid as much in commission as the share was worth. It was like $20 commission for a $25 stock.
And do you still own them?
No, sadly, I got rid of McDonald's and Nike because I don't know, at some point I got older. I felt I knew what I was doing, so I had to start trading, obviously, because I can make a lot of money by bouncing from one brilliant idea to the next. And you realize that doesn't really happen. And maybe I should take a step back and look at the long game. So that's a good.
And I mean, what how is it? Can you explain then a little bit, like how that went? So you were 11, 12, your first shares. Was this then a ritual every year? And when did it really become serious for you, in the sense of that you saw like, okay, hey, this is becoming serious money, and yeah.
Yeah, so I would ask some relatives for some cash for stocks. I had a family friend that was really into it, and so she helped me kind of lean in a little bit. Every birthday, she'd give me $100, and I would go buy a share. And over time, like, I got distracted as a kid. You go do what you're going to do as a kid. It kind of clicked along, but you'd look back on that, or I would look back on the account and think, oh, it's growing. This is really interesting. Maybe I need to learn more about what this means and why did it move up or down. And that led me to be a finance major in college, if I can just fast forward. And from there, I really got to understand the math and the science behind it, and what it meant to run a business and how they can last for 50 or 100 years. And that longevity really made me curious. And I continue to try to learn more and try to invest more. And I've bounced around from different strategies over my lifetime, trying to figure out what fits me as a person, like what gels with my personality the most.
And what is it today?
I'm trying to be a buy and hold. It's tough in this market because it's so you get so much media pressure to go do something else to get you to act and engage. But the more I read about really smart investors that are much older than I am, the more I learned that they make, you get a couple opportunities to make good investments every so many years. You don't have to make a move until it's clearly evident to you that this is a great deal, and you buy it and you hold it for a long time. And those people hand hundreds of millions over their generation because they made one good move and they didn't touch it. I'll tell you a brief story. So part of your question earlier about putting money away and then what happened to it, I forgot that I had a Roth IRA years ago. I bought some shares of Apple because at the time it was an interesting stock and people were running around with the headphones. Here you go. And I forgot that I had the shares entirely. And I think a decade later, I looked at the account, it was up massively. And I never touched it, never added money to it. And that to me was eye-opening, because here I was thinking I was a finance major and I knew what I was doing. I was trading and doing all kinds of fancy moves. And then this other account that I bought and forgot about was outperforming whatever brilliance I thought I had. So that to me was a nice kick in the teeth of like, hey, maybe all this movement isn't actually progress. And I should go just slow it down. And that's when I started looking more into a real value investing strategy and how do I position something for a decade or 25 years from now.
It's really interesting that you mentioned that, because I've got kind of an MBA as a background, so I get all the finance courses, accounting. Yep. And what I struggle with is actually with this, you when you understand the information, you are subject also to getting sucked into the information and therefore lose kind of the helicopter view, right? So what I'm really trying to work on is to become a bit more streetwise when it comes to investing. So really sensing when this is indeed a good buy. Of course, you need your data here. And what I've learned actually, that every year there's one stock or something like that I've got conviction around, but it's usually just one. So last year it was Ahold Delhaize as an example. The year, I think in 2018, it was AbbVie, which was trading around 60. And do you have some similar experience like that is really like a small amount actually every year where you have some conviction around?
I think that's right. I mean, for me, Facebook was one that I looked at. I remember watching it. It was always trading at a premium for a long time, and I just couldn't get over the multiple I have to pay for it. And then at one point, Mark Zuckerberg gets called in front of Congress. This is actually only a couple of years ago. And it gets a lot of negative press, and the stock starts collapsing. And I remember looking at that and thinking that this is all PR, and no one. It's still a massive cash machine that's globally diverse, has zero debt. I'm like, why is this thing going down? So I ran over to the bank and I borrowed a bunch of money, and I drew out a personal line. I said, you know what, this is really interesting. Let me just go and make a bet, and this is my bet for the year. And that worked out really well, and I liked that strategy of waiting around until it's clearly evident that's a great deal, and then go make a move.
And how does that work then? You go to the bank and you say, I want money so they can buy stocks. And how do you feel comfortable with that?
In that particular instance, I was already 100% in the stock market. I had no other cash that I could put in. So I needed kind of an immediate loan. I went to my bank and said, hey, this is what I want to do. Yeah, I want to put in the stock market. And they're like, okay, how much do you want? I'm like, this is what I want. And I got the cash and I went and bought the stock. I don't know if I would recommend that to everybody, but in that instance for me, the risk, the reward dramatically outweighed the risk of the borrowed funds, and I had the cash flow to make the payments. I'm like, let's do it and see what happens.
So would you say Alibaba was at that space?
I've rebought twice now, so I hope it works. It's slowly growing actually rapidly growing as a piece of my portfolio, because I liked it when it was a whole lot more expensive. I still like it now, and I'm going to sit there and let it do its journey.
Yeah, super. I'm a average price of 170. So for me, but also thinking it could go to 300 over the next 5 years. So that's what I'm hoping for.
Yeah, I mean, you look at the company, you look at the market in China. It's massive. I don't think the Chinese are going to kick out foreign investors. They need that capital infusion to grow their country. They are repositioning the profits of that business a little bit, right, to benefit everybody. But that's just like changing tax rates, and so I don't see that as nationalizing a business. I see them as just increasing the tax rate on a company that's got very little capital cost and a high profit margin. Okay, I'll do that.
And what one of your trademarks is really to look also at the company as a stock, as an enterprise, right? Could you share a little bit like how you're really looking at stocks, right? Are you buying businesses or are you buying stocks as an example?
Yeah, it's a great question. So when I'm pitching for an acquisition for a company that I work for, right, we're buying the entire enterprise, and you typically in an acquisition you buy a company on a debt-free, cash-free basis. So whatever debt they have existing when you acquire them, you're going to pay it all off, and you'll put in your own capital structure. And I like looking at a business that way. It helps to wash out some of the noise of how they finance their business. If they have a lot of debt versus zero debt, it can impact earnings per share. It can impact growth rate. But if I remove all that and say, let's just look at the enterprise itself, what are the total cash flows of the business, and are those growing? Then I get a clearer picture of where I think the business is going to go. For example, like a McDonald's or a Pepsi, we discussed earlier. Those companies have a lot of debt, and they have been growing that debt over time as they try to buy back shares to boost their equity price. They eat on a per share basis, and that's not growing a business. That's just manipulating the math to show people that focus only on a share price that number is growing.
Yeah, and then we see this probably, and this may be also nice, nice switch also a bit to dividend investing, because we see this, of course, also a lot with dividend investing. So our audience is really curious about your thoughts about dividend growth investing as well, and how you look at that probably from a capital allocation point of view as well.
Yeah, so I think I first started at cash flow, right? So back up a layer. In order to have a dividend, you have to have the cash flow to meet it. The dividend is a decision that the board makes on how much they want to pay out. So if free cash flow is strong, is growing, then they can afford the dividend. Then I think it's a great investment. If they get, what I'm seeing is some of the dividend aristocrats get married to the dividend. They can't change it, right? AT&T is a great example. They're paying out a massive dividend. They could barely afford it. There is no room for error. Something happens in the capital markets, they're like, they can't afford it. They're like, oh, I have to cut the dividend, and the share price is massively hurt because everyone was buying it simply for the dividend. So I love dividend investing, but I would say make sure that free cash flow first is strong and growing, and the byproduct of that is a nice dividend you can rely on.
Yeah, and I think what you're speaking about there is there's a difference in dividend investing and dividend growth investing, whereas dividend investing is chasing maybe high yields and companies like AT&T. Dividend growth investing, I mean, we focus on cash flows, revenues. We focus on these things, so they have a safe, sustainable dividend that they can grow. I mean, if they're not growing their top and bottom line, they can't grow their dividend. I mean,
that's right.
They can't grow it. So I think that's why our focus is primarily dividend growth investing and not just dividend investing. I think that's one of the key things we like to put across out there.
Yeah, you can get burned pretty hard chasing yield. Like if you just take a simple screen of stocks and just rank by the highest dividend yield, and someone's paying 11% dividend, it's probably not going to be paying for that for very long. So
we have experience with AT&T in the community where it was like buy AT&T on the 30. Yeah, this was such a clear sign of yield chasing. Then it was buy AT&T on the 29, and I think then it stopped because people started to lick their wounds, right? Yeah, yeah. For me, AT&T is a really interesting case because it was written on the wall that they had to cut it, and it was not because of the dividend or something as such. It was just mistake after mistake after the mistake with the acquisitions. Then actually kind of lying to investors, right? By saying that it's all good and opportunities and. But if you took the clue from the cash flow and the debt levels, it was clear that the dividend was not sustainable, and they had to do something also with the spin-off.
Yeah, remember that CEOs are salesmen to some degree. Like they rely on, they obviously earn their salary from the company they're working for. They have shares in that stock. They have a vested interest in making sure that the stock goes up. And that can be detrimental too. Like they could not want to give honest, real guidance because it's going to affect their personal net worth or their job. And there's a little bit of you have to step back a little bit and realize that sometimes they're talking to you and it's a sales pitch. It's not what is likely to happen in the future. It's what they would like to happen in the future.
Yeah. This is also always so tough for me because I think when I look at Wall Street and if I look at the news and the headlines, they're often just parroting those headlines, right, that come out of the press releases. And how do you deal with that yourself? Because there's so much you can analyze on a day, and look at. So how do you deal with that yourself?
It's very hard. It certainly with social media growing as fast as it is, there are a lot of people that are publishing articles for just the clickbait. I think I saw an article on Twitter the other night. It was Palantir, and it had fallen down. And this article was basically quoting Buffett that when people are fearful, you should be greedy, and that quote, and relaying it to the drop in the price of the speculative stock, and so therefore it's a buy because it's gone down. I'm like, this is just a clickbait article that someone published. And what I try to do is that's why on my channel, I look at 10 years of financial information and I lay it on the screen. It helps smooth out all of the noise between 1 year to the next, 1 quarter to the next. It smooths all that out. And for me, it becomes much simpler.
Yeah. And for the retail investor, I mean, you spoke about clickbait. And that's only targeted at retail investors. There's no institutional investors reading that kind of bullcrap, I'm going to call it. But for a retail investor, what do you kind of wish then that they would understand a little bit better so they're not clicking into these headlines and not getting caught with these?
I think if they can try and understand what the value of something is and then realize that the price on the screen is different from the value. People say that the markets are efficient, and I do believe they are, but they are also highly inefficient for long periods of time. And just because someone's offering you the shares of a stock for a particular price doesn't mean that that stock is worth that. And if you equate it to maybe a pair of shoes and said, how much would you pay for these Air Jordan shoes? They would probably be easier to tell you the value of those shoes than the stock price.
Yeah.
And that's probably just an education piece.
And does this kind of looking at value, how do you then look at gold and Bitcoin or cryptocurrency? That's hard, right? As a value investor.
Very, very, very hard. I read that Bill Miller has like 50% of his net worth in Bitcoin, and I was scratching my head. I didn't know why he would say something like that or do that.
Yeah.
It's very hard to value.
But you use EBITDA, don't you, when you're valuing a company? And we all know Warren Buffett was not a fan.
He hates
of this whatsoever. I know we have a quote there. He's not a fan. But why do you use this then? Why do you use EBITDA when you are valuing a company?
Great question. I do two things. One, what is the free cash flow, right? So I look at that every single year. And then you're right. I use EBITDA to benchmark as a relative metric to the enterprise value of the company. Enterprise value divided by EBITDA. Two reasons. One, lots of companies the finance industry as a whole runs on EBITDA, for better or worse. That's the metric they use when they report acquisitions. So if Johnson & Johnson were to buy a company, they'll say, hey, we bought this company, we paid 10 times EBITDA. So there's there's market data coming to me about rational investors making acquisitions and reporting on a multiple of EBITDA. So that market data I can take and say the market is paying 12x EBITDA for this business. I can take that as a data point and then apply it to the companies I'm looking at. And I get just a broader spectrum of people valuing businesses off of that metric. And that's why I use it as one of two methods that I look at.
Yeah, and then often we see, for me, it's always like really funny. Then we have people also reporting adjusted EBITDA. How do you look at the term adjusted in itself? Yeah.
I mean, the adjustments are supposed to be when you're buying a business, you're paying a multiple EBITDA, and someone will say, well, last year I had this issue. It was clearly one time. And, you shouldn't allow that to lower the value of the business because you're valuing it based on forward cash flows, not last year. So I want credit for it. And they'll argue for, hey, add that back. And that's fine. It happens all the time. If there's some sort of, I don't know, like a regulatory issue or like, say, a legal settlement, if you had to pay a legal fee, it's one time. But when people
unless it's a legal fee every year because of
exactly, yeah. So
business. Yeah.
Totally, exactly right. If it turns into this annual problem, then that's not an add back. That is your business, and it needs to be removed.
Yeah, good point. And I know we're now a little bit technical here, maybe for some listeners, but there was also really a particular question around free cash flow, and the question was like, why do you use free cash flow for equity over, I guess, the more normal or popular free cash flow? And maybe you could start a little bit explaining in 1-2 sentences what free cash flow for equity is as well.
Yeah, so the free cash flow to equity is the free cash flow. So operating cash flow on the cash flow statement. What do they make when they run the business from year to year? Less your CapEx, the money you have to put back in the business to grow it, and then plus or minus any debt changes that you made in the year. If you add all that up, you get free cash flow to equity. That is ultimately what we're buying as equity owners. The other cash flow would be free cash flow to the enterprise or to the company level, which basically doesn't account for the debt. It's just basically cash flow from operations less CapEx.
And I guess in your business, when you're evaluating companies, you're looking at the equity part. Because of acquiring and not necessarily, you don't want to take the debt into consideration because it's owned by the bank, I guess.
You kind of. So if you have a company that's really highly leveraged and has to make really big debt payments every year,
like AbbVie,
I'm not too familiar with that one, but
okay,
or
AT&T.
There you go. And stick in the States, it's easier for me. But you're right. If you have to make significant debt payments every year and you use cash flow to the company, then you're excluding that entire payment that's mandated by the banks, and they would repossess the company if they stop making it. You're excluding that cash outflow in your numbers, and it's something that in this market, the way we are, as low interest rates, as low as interest rates are, and the amount of money people have borrowed, we really need to take that into consideration.
Yeah. Good. So I think we'll get back to some more questions from the listeners soon, but we also would love to hear a little bit about your YouTube channel. So
thank you.
Happy to, how is it? Do you also see it as a business, or how is it for you? Maybe the whole journey and
Sure. So I started it actually in March of 2020 with the collapse of the stock market. I thought it was overdone, and I thought, I'm gonna lean in, and I borrowed money, like I was saying, and was buying stocks. Why don't record this journey? And so I started putting videos out there, and I was very surprised by the feedback I got, the questions I got, the comments, and I said, well, I'll keep doing this. It's not too hard, and it's grown into a community, and I've really enjoyed talking and reflecting with these people that are like-minded with me. They're just trying to buy safe investments that they can hold for a decade, and I'm really enjoying chatting with them. It's not necessarily a business for me. I have my more than full-time day job with 2 small kids, and it's like just finding the time to do the channel. It's been a lot of work, but it's fun for me to put out a forecast, watch what happens over a couple of years, go back and watch that video and say, was I right? Like that is very humbling. And I've learned a tremendous amount from the viewers that are smell checking these numbers, and they're saying, hey, you missed this, or what about this issue? And that to me has been so rewarding and humbling. I really, really appreciate it.
And do you think then that your colleagues at work treat you a little differently at all? I'm kind of curious with this one, because I know we're kind of in the background here, but I've started to put my face a little bit on YouTube now, and nobody in work really knows what I do. So I'm just kind of interested how they take you where you work.
Most people think it's great. In fact, all people, they're like, "Oh, this is amazing. You definitely belong in YouTube. I'm so happy you're doing it." That kind of thing. It's been very positive. Good.
And the wife?
She likes it too. She thinks it's hilarious to see, the boy. I mean, we've been together for a long time. She's like, this kid that I knew in college is now doing this. She just laughs at it. It's fantastic. She makes fun of me more than anybody.
And I believe you have like 40,000 subscribers, right? So that means you're really an influencer on YouTube now. Yeah,
we're coming up on it. I started out of the channel. I started a website called cashflowinvestingpro.com. And there I started teaching a course for the people who really wanted to learn how to do it themselves. Because I found that I was getting so many requests for stocks, I couldn't possibly do them on my own. I was like, well, I'll create a course and let people learn how to do it. And that has been amazing. The amount of people who have purchased the course is overwhelming interest. The feedback has been phenomenal. And I'm really happy that we can teach people to do this on their own. And hopefully that will then carry on to their future for 20, 30 years. It could help change the course of their investing career. That's what I want to do, is help people get where they want to go.